And good evening to all the viewers. My name Mohammed Aashikkhan, and this is my very first video series on cost accounting. Just to give a brief about my profile, please look into this. Mohammed Aashikkhan, FCCA UK, ACCA Sri Lanka, ACMA UK, CMA equivalent to CPA US, ACCA Sri Lanka, Australian Institute of Public Accountants Australia, Certified Fraud Examiner from US, and MAT from Sri Lanka. I am the Managing Director of Global Business School Sri Lanka, which operates training centers in Sri Lanka, Dubai, Qatar, Bahrain, and many other countries. And we offer this list of courses: CIMA UK, ACCA UK, CA Sri Lanka, CMA US, and CPA US. The subjects which I am specialized with: financial accounting pillar, which includes basic accounting, intermediate accounting, and advanced accounting for CIMA qualifications and ACCA qualifications. Also, management accounting pillar, introduction to costing, performance management, and advanced performance management in any of those qualifications for CIMA or ACCA. Plus, auditing, financial management, and business strategy. This much is my introduction, and let's begin with a basic topic today to start with the break-even analysis. Hi viewers, let's talk about the very first session on the basic cost accounting break-even analysis. In other words, we call it in short BEP. For the discussion of break-even analysis, there are certain basic concepts that we need to understand. Those concepts that I am going to discuss currently. The very first concept is the term contribution. A very important term. From a basic accounting point of view, we all know what is the meaning of gross profit. The gross profit is equal to sales minus cost of goods sold. This is from basic accounting point of view. If I reverse this to a cost accounting point of view, that is what exactly mean by contribution. How I calculate contribution is equal to sales minus variable cost. So you can clearly see now the contribution defined by giving us two new terms. The first term is sales, that is this, and the second term, which is variable cost. So in try to understand contribution, let's try to understand the terms of these two terms. So let's start with sales. This is a golden term for every business. Every business survival, sales are very important. In other words, sales means the revenue that we generate or the income that we make. This, if suppose, for example, company X sells widgets. Company X sells widgets, and the selling price of one unit, if I say $10. Mind you, in my lecture series, I'm going to use the currency US dollars for the convenience of all the viewers. So the selling price of one widget which the company X sells $10 per one unit. And if I assume the number of units the company X sells 100. The number of units the company X sells is 100. Therefore, are we in a position to calculate sales? Sales will be equal to the selling price multiplied by the quantity we sold. A simple formula. Now we know the selling price is equal to $10 and the quantity we sell or we sold was 100. So simply we are generating a revenue or a sales of $1,000. Now it is clearly need to understand two aspects here. One, if you are talking about sales per one unit, single unit, then we refer that as selling price. In many of the textbooks, they use a short form SP, selling price. On the other hand, if we wanted to talk about the revenue for a collective number of units, then we call it sales. So, we now very clear that the first term, sales can be for one unit, be referred to selling price, or several units, then we refer that as sales. So this is the very first term that you need to be cleared with, and that is sales. Second point or second term will be, let me erase the board. Second term will be, interesting term, variable cost. Now, if I hide this term here, and we have cost. Cost means any expenses that we need to incur in having any product or item with us. That's a very brief common language definition or explanation. On the other hand, when I combine with the term variable, that means the cost that will vary against the number of units that I produce or I sell. The cost will vary against the units produced or sold, based on the production increase or decrease. If the cost increase or decreases according to the number of unit changes, and if the cost is changing, and that cost we refer to variable cost. See the example here. For example, for that widget, the company X produces widget, and to manufacture one unit, the cost, let me say the total cost to manufacture one unit of widget, they need $4. Let's say, for example, total cost to manufacture. Actually, this combines several different components of cost, which are briefly direct material, means what is the cost of material that we need to have in producing one single widget. Direct labor, that is the amount of staff or amount of workforce or the labor that we need to use in producing one single widget. And we also have something called variable overheads, meaning the overheads that will vary against every single production of this widget. So, however, we say that the total cost to produce one widget is $4. Let me make out a small table. One unit I produce, so the cost I incur $4. So this is in dollars. If I produce 5 units, the cost that I would be incurring would be $20. And if I had to produce let's say 10 units, then the cost will be 40. If the cost varies in this pattern, and that cost is what I mean variable cost. So now you can recalculate or reconfirm our understanding. How we do that? We take the total cost, which is 4, and we divide that by the number of units we produce. The number of units we produce is 1. Answer, I am getting 4 here. Let's redo the same thing over here. 20 divided by 4, 5. 20 divided by 5, again the answer I am going to have will be 4. And we'll do the same thing for this one. 40 divided by 10, and again answer I am going to have 4. So this is what the meaning of the variable cost. So now we understood sales or selling price, variable cost. One more thing on the variable cost. Variable cost also can have on a per unit basis or on total. What I mean per unit basis, regardless of the number of units I produce, if the cost of this widget remain a single unit, cost will remain 4. You produce 5, you produce 10, you produce 100, doesn't matter. When you calculate the cost per unit, that remains static, and that is 4. The total, what I mean, if you happen to produce 20 units, then the cost will be then 20 into 4, and that amount to 80. So this is the meaning of variable cost. So now we understood sales or selling price, variable cost per unit or in total we understood. Now let's try to calculate contribution. Contribution is equal to either selling price minus variable cost per unit. This is one formula. You can calculate the contribution on a single unit basis or a per unit basis. So that means selling price minus variable cost. If I take the example which I used, one widget, selling price we said $10. The variable cost we said $4. So therefore, let's apply that over here. Selling price $10 minus variable cost $4. So the contribution I am having is $6 per unit. So in other words, it's more of a profit that we are generating in selling any products or production against our variable cost. This is the contribution we referred to. So first thing, under variable break-even analysis, we need to have a knowledge of contribution. Now, once you know the contribution, and then we also should be able to calculate total contribution. What is total contribution? You see, contribution per unit into number of units we said. Number of units sold. So the contribution per unit we know 6, and if I assume the sales units 200, just for the sake of example, then the number of units we sold will be 200. So the contribution in this example 1200. So this is one way of calculating total contribution. We can also alternatively calculate the total contribution in a different manner. How? Please follow me. We need to have the total sales. We know that the selling price how much? $10. And number of units we sold? 200, amounting to the total sales of 2000. Then we need to have the total variable cost. The total variable cost will be per unit $4, and we have produced and sold 200 units, so therefore 800. If you subtract 800 from 2000, our answer is 1200, and that is our total contribution. So you can calculate total contribution in two ways. One, following this formula, or following this formula. So now that we are clear about what is sales, what is variable cost, and how to define contribution and how to calculate contribution. Next concept or next point on this series will be try to understand the concept of fixed cost. We'll try to understand that now. We understood variable cost. We said that the variable cost will vary against our production. Whereas the meaning of fixed cost, the fixed cost will not vary against our production, and fixed cost is a periodic cost. Regardless of the level of your production, regardless of the level of your outcome, the fixed cost will remain the same. For example, if you have to continue the production of widgets, you produce widgets, and we say that variable cost is $4, but we need a place to have the factory. And if the company cannot own their own factory, then the company need to hire or rent a factory. The landlord or the owner of the building will not be worried about the number of units the company will produce. The landlord will demand a given amount of rent. The landlord may say, regardless of everything, the rent you have to pay me is 40,000. Or let me make it a little bit simpler, 60,000. $60,000 per annum. Now, doesn't matter you produce 1 unit, you produce 10, you produce 100, you produce 1,000, you produce 10,000, this cost will not vary. But under one condition, if the capacity exceeds the limit, then the fixed cost may vary afterwards. That we will discuss in a separate session. So therefore, the meaning of the fixed cost, it is cost fixed in nature, and will not vary against level of its outcome. Fixed cost is a periodic cost. This is what the meaning of the fixed cost. So now, let's continue that example we have. And we assume we produce 10,000 units. We produce, let me say 15,000 units in total. So let's calculate the sales. Sales will be 15,000 into 10, 150,000. Variable cost will be 15,000 units into 4, that is 60,000. So my contribution is 150 minus 60, that will amount to 90. Now, in this example we said our fixed cost or the rent, which in other words fixed cost, is 60. So net profit is 30,000. This is a normal basic accounting calculation in arriving the net profit. The use of this now, if the company want to know what will be the minimum units that we need to produce in recovering this fixed cost, that the company need to know. And that is exactly what we try to understand the term break-even analysis. In other words, when the company will break even in terms of their total profit is equal to 0 or no profit, no loss situation. Let's try to understand that. As the term suggests, at break-even point, we say that the profit is equal to 0. We say that if the company to break even, the total profit must be 0. Now we know how to calculate profit. Profit is equal to sales minus variable cost minus fixed cost. You can see this here. See, sales minus variable cost minus fixed cost. Now we assume the output, the quantity we produce is X. We assume like that. If I assume the selling price, we know selling price is $10, so 10x minus variable cost per unit, we know $4, so in total $4 into the number of units X, so that will be 4x minus we also given the fixed cost is amount to 60,000. So, and we know that at break-even point profit is 0, therefore this must be 0. So when this is 0, 10x minus 4x, basic mathematics, it is 6x minus 60,000. Again 6x minus 60,000 is equal to 0. So if I apply the mathematical rule and I will move the 60,000 to this side or vice versa. So if I do that, 60,000 is equal to 6x. You see the sign minus here, when I move in this side of the formula, and that will become plus. Hence, if I to calculate x, answer will be 60,000 divided by 6. I will write it down here, 60,000 divided by 6. And that's a simple calculation. This will be 10,000. This is the way we arrive the break-even point using a mathematical approach. But the cost accounting has already given a formula for this. What is the formula? Formula is, if you want to calculate break-even point in quantity, what you do is take the total fixed cost and then divide by contribution per unit. You see, I have taken 6 over here. That 6 is, in other words, 10 minus 4. The 10 is the selling price, 4 is the variable cost. We learned at the very beginning, selling price minus variable cost is the contribution. So therefore, the contribution per unit is 6. And I also have taken 60,000. From the example we learned, this 60,000 is nothing but fixed cost. So therefore, we take that answer here as well. Then you simplify this and you get an answer, and that is break-even point in quantity. That's all for the day. Let's have the next session in the subsequent videos. Thank you very much.